Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about the 3 top best growth stocks to buy right now. We're going to be talking about Mercado Libre, Celsius, and Expel. The first company we're going to be talking about is Mercado Libre, which is one of the stocks that I personally own that is on this list. Mercado Libre stock has literally surged around 800% just in the last decade. Similarly, Celsius stock, which is the next company we're going to dive into, has jumped over 21,000% over the last 10 years, and Expel stock has increased their stock price by an astounding 43,000% over the last decade. So all of these companies are rapidly growing and they are rapidly developing, so I at least want to put them on your radar. Despite the robust sales of all of these companies over the last 10 years, they have also returned very impressive stock price appreciation over the previous 5 years. And the 3 stocks on this list all have a fantastic growth rate that I think in the future could either continue to accelerate higher or maintain their current momentum. Now, I do want to say that although the historical growth of a company does not dictate their future growth, it is a good place to start when we are trying to evaluate and compare stocks to one another. As we all know, the growth rates of companies change over time, and normally as that company becomes larger, their growth rate tends to dissipate. However, for these companies, these particular businesses have been on an absolute tear lately over the last decade. And the best part is that these businesses have actually posted even higher projections and figures this year for last year and even this year to top off their fantastic growth trajectory. So that's why these 3 companies are on my watch list. However, Mercado Libre in particular is a stock that I personally own. We will be diving into what these companies do, why I like them or dislike them, and why at minimum you should at least have these on a watch list. So for more videos like this one, remember to go and smash that like button right now, comment your thoughts down below, subscribe if you are new, and without further ado, let's just jump right into today's stories. So the first company we have on our list is Mercado Libre, ticker symbol MELI, ticker name MELI. Basically, they operate a very successful e-commerce platform that absolutely dominates Latin America. However, they also have another segment that makes this company a fintech company, which is a very interesting segment of theirs. Right now, the MELI stock trades for $724.75. However, investors on the very bearish negative end think that the company should be at least worth $850 right now, and very bullish analysts as well as investors think that the company could surge to $2,036 per share over the next 12 months. And this would imply that investors as well as analysts think that the company is currently undervalued because of the giant pullback that the company has had for their overall stock price. Like we said earlier, over the last 10 years, the company has increased their overall stock price by 800%, and that is despite a rapid decrease in the stock's current price. And the reason for this is that fintech companies as well as growth and technology companies have been hit very hard lately, and Mercado Libre is one of those companies that have been hit very hard, which is why some investors are using this as an opportunity to buy up this particular company, because according to investors and analysts, it is undervalued. The company is posting absolutely phenomenal revenue growth because their overall revenue growth year over year for the first quarter of 2022 came in at 65%. And that is pretty astonishing, because if you can find a company that is scaling at over a 30% CAGR or compounding annual growth rate in regards of their revenue, that company is rapidly developing and growing. So it's really good to identify companies that can not only maintain this momentum, but are continuously growing at this phenomenal rate, especially a company that can do this for multiple years, year over year. Like we said earlier, this company has 2 main core business segments. One is their commerce segment and the other is their fintech segment. Their commerce business grew by around 44%, which is still absolutely amazing. However, their fintech segment grew by around 113% in total, which is absolutely igniting the overall stock price. Investors really want to see this because this allows diversification within the company, because it doesn't just have one core business, it has 2. Currently, their fintech segment accounts for around 43% of their overall total sales, which is almost 50% of their total revenues, which is a very large increase from just last year, where their fintech segment only made up around 34% of their overall sales. It reminds me back when eBay and PayPal were literally the same company before they split. If you didn't know, about a decade ago, PayPal, which is a fintech company, separated from eBay, and once that happened, it allowed PayPal to increase in their stock price by around 700% in the following 6 years after they actually divided. And this could happen, however, if both their business segments stay together and they do not end up separating, this is going to cause the MELI stock to absolutely ignite over the next decade or so. Another reason why investors are paying attention to Mercado Libre's stock price is because this is a phenomenal growth company that is trading at a giant discount because of the recent sell-off in growth stocks and technology stocks. Even with the price down around 50% year to date, they do have a very competitive price to sales ratio, or PS ratio, because as the stock price drops, their PS ratio, or price to sales, also drops, making this company an even better buy. Right now, the PS ratio is only hovering at around a 4.339, which is very low for a growth company. However, with that being said, they do have a very high price to earnings multiple of around 87. And although that can sound expensive, and in my opinion it actually is expensive, analysts project that the company will grow their sales by around 50% this year, which will further decrease the price to sales ratio and hopefully reflect very positively on their price to earnings ratio, because after all, this is a very rapidly growing business and this is a growth company, which means that you are willing to pay a premium now for the company due to your perception of what the company or stock price could be worth well into the future, probably 5 to 10 years down the road. And right now, Mercado Libre is really on track to achieve a fantastic stock price well into the future of over $1,000. I do want to mention, although Mercado Libre is rapidly innovating and developing, they are currently not profitable, but they are foregoing profitability on purpose so they can continuously build out their fintech, logistics, and credit ecosystem, which will benefit them for the long term. So they are purposefully putting the brakes on their profitability so they can further innovate and grow their business internally. And even right now, the current valuation of the company is very tempting for growth investors due to the massive upside potential in the future that this company possesses and the long-term cash flow that this company could be bringing in. Now, with that being said, I again do hold Mercado Libre in my personal portfolio. However, I would encourage you to do your own research on this company to make sure it aligns with your risk tolerance and your investing style. The next company we're going to talk about is Celsius Holdings. And Celsius is literally combining the worlds of energy drinks and health and wellness. This company over the last 10 years has absolutely exploded by appreciating around 20,000% from their initial stock price, which is incredibly impressive. If you would have identified this company back before it surged 20,000%, this company could have easily made you a millionaire. However, it's not done yet because the current market cap for the company is only at around $6 billion, and analysts think that the company still has stock price appreciation left in it. For instance, investors think that the company is worth around $55 or $120 over the next 12 months. So I tend to think somewhere in between there, probably around $90 would be my guess, while the current stock price hovers at around $75.38. But what is the real draw to this particular company? Well, the first thing that I want to point out is that this is an energy drink that helps you burn calories. According to several clinical studies and trials, their drinks and on-the-go powder actually helps people burn around 140 calories per a 12-ounce serving. And many of their consumers like this, which has given them a fantastic sales growth of 74% over the last 5 years on an annual basis. And again, 74% is well over that 30% CAGR that we were talking about earlier, which makes this company a rapidly growing and developing company. This is also a rapidly expanding business, but what do I mean by that? This company literally has increased their overall convenience store locations by 88% 48%, which is almost unheard of. Now they have increased their total door count by around 53% to over 140,000 stores in the United States that carry this product. More good news is that Celsius is just scratching the surface of the overall US energy drink market. Right now, they hold around a 4% market share. However, as time goes on, I believe that they can attain much, much more than that. For instance, if we just take Amazon and the Amazon market share of energy drinks, the company is only second to Monster. Right now, Celsius takes up around 18% of the market share regarding energy drinks on Amazon.com, while Monster takes up around 26%. So this drink is extremely competitive in the energy drink market because it's going against companies such as Red Bull, Rockstar, Monster, and many other energy drinks such as NOS. But in my opinion, what gives this particular energy drink an edge over its competition is that this is a quote-unquote healthy energy drink that helps you burn calories, and not many other energy drinks are going over that particular market. More good news is that Celsius is currently trading at around 16 times their sales, so they have a PS ratio of 16, which in my opinion is rather high. Ideally, we would want a PS ratio for a decent growth company below 10. But what's really good about this company is that this company has recently hit profitability, which is not a bad thing. Despite a high PS ratio, it's really good that this company is technically profitable. I think as the company continues to grow, the PS ratio that's currently at around 16 will decide to plummet. Now, right now, I think any type of profitability is impressive, and the author of this Motley Fool article thinks the same. And if we pair that with their very impressive growth rate, this could be a fantastic company to hold for the long term, because even after the stock price has increased over 20,000%, there is still upside left in this particular stock. The next company we're going to talk about is XPEL, ticker symbol XPEL. And the absolutely astonishing thing about this company is that its share price has appreciated over 40,000% in the last 10 years. And that means that this company is somewhat of a software as a service unicorn company, which is extremely rare. And they are a leader in their particular segment, which is basically car tinting and protective films for vehicles. The current XPEL stock price trades for $56.59. However, even critics of the company think that the company is undervalued right now because they think it's worth at least $75 and at maximum $78 per share. The company also has a relatively low market cap of only $1 billion. So if you could have identified this company while it was even lower, this would have been an absolutely insane company that could have made you a millionaire multiple times over. However, the real question now is, does the company still have upside potential? Well, that really depends. I do think that it is a leader in the protective film and automotive window tinting market, and they also offer residential and commercial window tinting as well. More good news is that this company has decided to expand their overall reach globally. Even though right now they are very centralized in the United States market, or the market in North America, which currently accounts for around 70% of their total sales, they are expanding worldwide to get that overall market reach. Based on current statistics and metrics, they have a very balanced growth rate and a very good PS and PE ratio, which are rather balanced. However, I personally would not be investing into this company because I personally just deem it a little too risky. XPEL's valuation has been cut in half from its recent highs. However, this is a very rapidly growing company that could still have a lot of upside left in it. For me, it's just very speculative. They have a PE ratio that currently clocks in at around 47, which is high, but not as high as some of the other companies on this list. Now, out of the three companies that we have actually looked at, which company do I think is the best for the long haul? And I actually think it's going to be Mercado Libre, not Celsius, and not XPEL. And according to this article, all three of these companies are fantastic growth companies to buy, or at minimum put on your watch list. As always, remember to do your own research before you use your money to invest into any stock or company. Comment your thoughts down below, subscribe if you are new, and I will see you in the next YT video.